Hello, gentlemen, and welcome to another Pallavi Market Research video. Today, I'm going to be discussing how to study negative space in spaces. Because Joe Rogan just had Terrence Howard on his podcast, and it turns out Terrence Howard is a real life genius. This guy is studying the negative space of sacred geometry and using what he discovers and applying it to technology, right? He's building drones and all these sorts of crazy things. He has a patent that all of the major tech companies are using in order to help them create AR and virtual reality devices and software. Now, what a negative space is, especially in the context of financial markets, what we're about to talk about in a second, is the opposite of what is visible. We are in a three-dimensional world. So the things that are easily apparent to us are observable phenomenon, right? So what we really want to understand is what isn't observable. So in the context of financial markets, negative space actually refers to areas where there is a lack of attention, analysis, or investment, right? It is the shadow of the opportunity that you are and everyone else are mostly tracking. Okay? So we're going to talk about what causes that and what positive spaces are. These are essentially to understand them at a high level. These are undervalued stocks in a niche sector. So maybe this was like a semiconductor startup or a mid cap semiconductor startup in 2018, 2019 before COVID and all this crazy conductor stuff, the demand for that going up, blah, blah. Emerging markets with less analysis coverage, alternative assets that are not as mainstream, like art markets are also really alternative and big. Market anomalies that are not widely recognized. Positive space is the stuff that you guys know about. It's the stuff that's well covered, heavily traded, and generally well understood by the people participating in them. This is the S&P 500. This is Apple stock, big stocks, Amazon, commonly traded commodities like gold and oil, and highly liquid bonds and currencies. But if we're going to be identifying negative spaces, if we're going to build the skill of actually being able to see this part of the field that in the financial markets, right? We want to basically start identifying market anomalies, regulatory changes, technological innovations, geopolitical events, and behavioral finance. So these are the things that are going, these are kind of like the breadcrumbs that'll get you to seeing negative space based opportunities, I guess. Because like regulatory changes is an awesome example. To use a super simple extension of that example is say Venezuela. Venezuela, if they were to become a democracy with private property rights tomorrow, their property values would go exponentially higher, right? Agricultural farmland in Venezuela would skyrocket in an amazing way because, and also it's not a perfect comparison because the value of that is zero because there's no ability to own those things, right? In those types of events, and that would also include a geopolitical event, right? In those types of moments, disproportionate outcomes are given to those who are willing to take the risk of actually going into Venezuela and buying a bunch of shit up, right? So, in order to, again, find these metrics, right, to actually, like, what are the different methodologies that these hedge funds use, essentially, we're going to be discussing in these next four slides. There are four parts here. So, alternative data, I'm sure you've heard about like different hedge funds using satellite imagery to track like the number of cars in a parking lot for a Walmart, a Home Depot, right? So that would be a great opportunity of studying negative space. And then, of course, sentiment analysis, which is a lot more, which has become a lot more popular since, obviously Wall Street bets and things like that. Liquidity metrics, of course, tracking the liquidity of these different opportunities. The VIX is very interesting. I don't really understand VIX trading that well, but obviously, if you're trading on volatility, the VIX index, the volatility index itself is volatile, so you can make a bunch of money catching those spreads, of course. And then earnings revisions, right? So, of course, there's a bunch of interesting things that earnings revisions can trigger because Wall Street can one day decide that a certain type of business now deserves to be trading at this type of multiple. So understanding those, and that's actually kind of overlaps into this second bullet on this slide as well. So if you're able to track those changes, those, evaluations, then you're going to be able to do well. Short interest, squeeze trades. This is again the whole GameStop thing in another context. And then cross asset correlations. This is a pretty interesting way to measure opportunities, especially over long periods of time. So like this isn't a perfect example, but like looking at stocks and denominating their share prices in gold prices instead of dollar prices because of inflation and things like that. Really interesting. Seeing the correlation between Bitcoin and Ethereum to Avalanche to whatever, right? The Celestia, maybe. These different layer ones with similar growth trajectories, right? Those are really interesting to study. So I made this video today because I wanted you guys, again, this is a do your own research supplementation channel. We're entering highly uncertain times. So in these uncertain times, you guys need to have as many skills in your pocket as possible. I made these this way, by the way, so that you guys can screenshot these, right? And have them in your pocket. I don't just write these out for no reason. Okay. Now, we'll talk about this later. And I'll see you tomorrow, I guess. I'm back to doing these every fucking day for a while. So I'm pumped. I hope you guys are too, because we're stepping this shit up.